Ja, rigtig hjertelig velkommen til dette webinar med SKAGEN Globals porteføljeforvalter Knut Gezelius. Mit navn er Søren Risager, og inden jeg giver ordet til Knut, så har jeg lige nogle praktiske bemærkninger til mødet. Hvis der er nogen, der ikke kan se præsentationen, så har vi erfaring for, at det kan hjælpe i at lukke ned og så åbne igen. Præsentationen den er delt nu. I har alle fået slået jeres mikrofoner fra. Når Knut er færdig med sin præsentation, så vil vi åbne for jeres mikrofoner, og der vil blive mulighed for at stille spørgsmål til Knut. Hvis I hellere vil skrive jeres spørgsmål, har I også mulighed for at gøre det her i Skype ved at trykke på det lille ikon, der er nederst til venstre på jeres skærm, og skrive spørgsmål til venstre for ikonet. Knut vil tale engelsk i dag, men I er velkommen til at skrive og spørge på dansk. Knuts præsentation optages og vil derved kunne genses på et senere tidspunkt. Og værsgo til dig, Knut.
Thanks everybody for joining us for an update on the market and SKAGEN Global, how the fund is doing and what we're seeing in the On that part, myself and my colleague Christopher Simonsen continue to run the fund according to the principles and the framework that we have shared with you in the past. And we thought just a quick refresher of sort of the key elements behind the strategy, kind of looking at the dashboard about the fund. Clearly, the number one focus for the PMs is the performance. To deliver an outperformance versus the index. We also integrate the ESG principles into the analysis, and we've been recognized by Morningstar for doing that part. Long term is a thing that we talk a lot about, the importance of being able to stay away from the noise and think about the longer term rather than getting sucked up into a short term trading, which is something that we don't get ourselves involved in. And then finally, concentration, high conviction. This is a fund, this is a portfolio where we look to find the ideas with the best long-term risk reward, and it's a high bar to make it into the portfolio, and we want to kind of deploy the money to the best opportunities, and there tend to be few and far between of them. So it means for the fund, as a reminder that of course everybody likes to get rich fast, but as we say that this fund is for those who want to get rich slow or over time, build wealth. If you want to kind of get rich fast, then maybe a casino, maybe a lottery ticket is a better way, but this is a fund that, I mean, make no mistake, we intend to outperform the index, but we're not gonna take huge risky bets, but we're gonna find the right way to kind of build the wealth over time, as you would do with pension capital, or if you save for your children's, sort of future. That's the type of fund that we run. So with that short introduction, looking at the agenda for today, we'll start to go through some observations from the market, what we're seeing, then we'll go into the portfolio, look at performance, look at positioning. We're going to run through an investment case from the fund to maybe give you a bit of a hands-on and tangible example of how we apply the investment philosophy in practice. And then finally, a few words about the outlook from here onwards, and then we'll open up for Q&A, like you heard Søren say at the beginning. So with that, if we kick off with the market, and obviously it's been an extremely volatile year. If we look at this graph, which shows you the FAIR index, the VIX index, the 5-year history, we see that kind of, at the peak here of the panic in March, the VIX spiked all the way to 83. And to put that in context, I mean, look at the history for the past 5 years, and it hasn't been anywhere near these levels. So it really kind of gives you a feel for how widespread and the magnitude of the panic in the market that we saw at this point in time. Now the VIX has obviously come down a lot, down to kind of 25 here, showing you that it's been clearly a big recovery, as we also know. And if we take a longer view, and as you've heard us say before, as SKAGEN Global, we like to not get too sort of sucked into the short term, but taking a step back and looking over longer term, and then we see that the VIX spike that we saw this year here around early March, that we had very high levels compared to a 25-year history of the VIX. I mean, you got to go back to the financial crisis to see something that was sort of in the same neighborhood. So again, really kind of makes you think about the huge impact that we had in the market so far. Now, it's obviously been a very quick recovery, and this whole episode to some extent reminds us of the phoenix analogy. I mean, the bird that comes back from the ashes, rises from the ashes. And why is that? Well, if we think about this 11-year bull market, started in March 2009, ended this spring, it was the fastest ever decline from peak to going into a bear market, so a 20% decline for the S&P 500 index ever experienced. This graph shows you sort of from different time periods back all the way until 1929, how many days it took for the market to go from peak to bear market here. And you see 2020, only 22 days to make that move. So clearly that explains also the steep spike in the VIX index. So kind of a very sudden, forceful death, but at the same time, as we know, the recovery has been equally fast and taken some commentators by surprise. This graph sort of shows you, in 4 to 7 days after the bottom for the S&P 500, how much did the S&P gain? Okay, and again, it was the fastest death, but it was also the quickest recovery. So this graph, which actually ends on the 20th of May, and as we know, the S&P is up over 40% by now. And it also shows it was the fastest recovery ever. So that's kind of why we have this sort of phoenix analogy in it. And interestingly, I mean, we're starting now to kind of hear some people talk about that maybe we shouldn't even call this a bear market, because it was such a sudden drop and quick recovery that maybe it should be seen more as some type of a natural catastrophe or just sort of a quick dip. And that's easy to say now, but if we think back of the sentiment in March, it was obviously very different than at that point in time. It felt to everybody like a big event, not just a short-term blip. So again, of course, perspective or time means different perspectives, but we should remember that it was a very kind of steep thing in the market. Again, I mean, you can ask yourself then, okay, I mean, where are we today? What are the levels that we've been back to? And this is from yesterday. This graph, it shows you the world index, MSCI, world all countries, going back for 5 years. And as you can see from this graph, now we're now after the quick rally, kind of back to where we were, where the world index was on December 3rd. Okay, so basically we've recovered almost all the way till December of last year, which is in a way remarkable given what things have looked like earlier in the year. And again, taking the long view, kind of going back 25 years, I guess if you had sort of seen this graph in March, it was going to look like this, you wouldn't be too worried about things. But again, just sort of telling you that the power also of the stock market to make these extraordinary comebacks. So with that, also we're going to go in and have a look at different levels, kind of market, sectors, and stocks for the index to get a feel for which markets have done well, which have done less well during the year. Now, this graph, I mean, it ends in May, so there's been some big movements over the past few days, not captured in here, but I think it sort of gives you the gist of things anyway. So kind of looking at the worst markets, Brazil, I mean, minus 39%, and that's a pretty big drawdown. This is all sort of in Norwegian krona here, but still the magnitude would obviously be similar for, or the relative magnitude would be similar for other currencies to a large extent. Oslo Börs down again, of course, given that the energy sector has been very weak. We had the global market being kind of just above zero. And then at the kind of best, the highest end, you will have Copenhagen being one of the best markets in the whole world so far this year. And in a way, a testament to the high quality, the resilience of many of the companies trading on the Copenhagen Stock Exchange. Nasdaq, of course, also strong given the benefits have been clear with the digital business models. If we take a step down and we look at on a sector level, best sectors, IT, healthcare, communication services, probably kind of as you would expect given the digital economy, given the defensive characteristics of some of these sectors. And on the other hand, you have the finance, you have energy being down quite a bit, and again, not too surprising given the collapse in the oil price and given the rates going down, risk of credit losses and so forth in the financial markets. And then finally, kind of looking at the best and the worst performers in the stock in the global index, in the world index, January through May, is interesting to make a few observations from this slide. Number one, just the difference in magnitude between the best and the worst performers. I mean, something like Moderna, which is a vaccine producer, a biotech company, up almost 250%. And we have Top Glove, the world's largest manufacturer of rubber gloves, being 200% up almost, and one of the best in the whole world global index. On the bottom side, kind of as you would expect, the airlines, cruise operators, energy companies being some of the worst hit. Insurance in Brazil here is one of the worst actually company by the end of May. So big dispersion should mean opportunities for stock pickers, and also of course has sort of a very unique fingerprint of the COVID-19 crisis driving the market changes. I think it's also worth kind of have a look at the oil price, and again taking the longer view to put things into perspective. This chart goes back all the way until 1996, shows you the price of the WTI oil futures, and I mean at the bottom here, kind of around $20 a barrel, similar to the levels seen in 2002, and you have that particular event happening in May when you actually had oil prices going to negative numbers for some quirky reasons, but obviously very kind of much a special case in that one. Interest rates continue to fall. This is kind of by the end of March, but I mean they are kind of at similar levels today. And here you can see it for the major markets. Again, this is a graph going back all the way until kind of 1970s, and the clear path toward zero has continued with Japan, with UK, with almost the US being at zero, India still around 6%, China kind of between 2 and 3, but it looks like this will continue, although we're not economists, so we're not in the business of predicting interest rates, but given the additional big debts being assumed by governments, and so forth, that it's hard to see how rising rates, absent of some type of big disruptive event, would be able to meaningfully rise from the current levels. And sort of maybe one of the final slides looking from a global perspective, this is the GDP forecast by the World Bank for 2020. You can see the scale kind of up here, where you obviously red means big contractions. This is probably as you would expect for most countries. China kind of being in a much better territory is interesting to note. And we also see that the World Bank currently is predicting a 4.2% growth in 2021. Let's see if that comes through or not, but it gives you a good idea of kind of where the world is currently, at least. And then the last point I wanted to make about the market is about valuation. I mean, valuation is one of the three things that you need to always kind of think about when you look at the overall situation here. And this is looking at the world index all the way back until 1995. And the measurement here is free cash flow yield. We recognize and understand that there are many different measures you can use when you look at the market. PE ratios, Schiller, I mean, all kinds of different metrics. But we believe that the cleanest metric, the one that is least subjective to sort of accounting and other types of manipulations, is a free cash flow yield measure, which has the quirky feature that when the free cash flow yield is higher, the valuation is lower. Yeah, similar when valuation is higher, or when the free cash flow yield is lower, the valuation is higher. So at the bottom of the financial crisis, we had free cash flow yield at 16%. That was very, very cheap. Whereas before the financial crisis, it was below 2%, pretty expensive. Over the 25 years, the average has been 4.9%. Yeah, so around 5%. And we can see that today the market is around 5.5%. So it's actually a little bit cheaper than the 25-year average, which to us just signals that it doesn't look like the market is hugely expensive. It looks to be sort of around the typical average value, which again gives us some optimism that it can do well over the next several years. So with that, come back to the portfolio here, and I mean, one thing that has come to mind for us is the quote by the former Intel CEO Andy Grove, who said that bad companies are destroyed by crisis, good companies survive them, and great companies are improved by them. Okay. Why have we thought about this? We've thought about this because we think that many of the companies in our portfolio will actually be able to improve their market positions after the crisis. Why is that? It is because they are well capitalized, they have good products, they have high human capital. So whereas some of the smaller, financially weaker competitors might fall behind, even go bankrupt, we think our companies will be able to kind of take a step forward and actually gain market share in many cases. And as you know, this is kind of the simplified version of the investment framework that will follow. But if you check all of these boxes, chances are good that you will not only survive the crisis, but that you will be able to take advantage of the new opportunities coming from the crisis. Here's a snapshot of some of the names in the portfolio you will recognize. Some of these bigger names, some might be a little bit less known here, but just to sort of give you the view that there is a kind of a good diversification, but not overly diversification in the portfolio. And we continue to believe that these companies have good or very good prospects as we look out years into the future. Performance, this is performance in measured in Danish krona as of yesterday. From the homepage, we can see that SKAGEN Global is ahead of the index, about 2.3% roughly in Danish krona terms year to date, and the fund is ahead on 12 months and on 3 years, and just behind on 5 years, but we're working to get that number up. If we look at the end of April, how the fund was performing compared to peers, this is a graph from Morningstar that shows you the breakdown by quartile, where the light gray areas is the fourth and the worst quartile. The dark gray is the top and the best quartile. And we have, as we have done a turnaround of the fund for the past several years, we have climbed in these statistics here and kind of been in the area where we want to be for the fund. The names in the fund that have had kind of the best absolute performance and the worst, the best ones: Microsoft, Old Dominion, and Adobe. I suspect that everyone is familiar with Microsoft and Adobe, probably don't really need many more comments given the benefits from their digital business models. Old Dominion is a smaller, much smaller, sort of family-owned company in the L2L, meaning less than truckload, so a transportation and logistics company based in the US. Excellent service provider, very sort of dynamic and nimble when it comes to managing the finances, and a company that we think will benefit from the e-commerce rise, and it's been sort of gaining market share over the past few years, and we think it may be one of those that will take even more market share as we look forward. The name has been a very strong performer year to date. On the bottom in red, we have names from the financial sector. JP Morgan, big bank. Hiscox and Beasley are two specialty insurers which have been hit because you've had first a number of years where there's been a lot of natural catastrophes happening which had weakened them a little bit, and then when COVID came in here and additional claims, that has been an additional burden on the companies. But we think that especially Beasley will be in a good position to take advantage of what is happening now in the market. I'm going to come back to that and go through a little bit on the insurance side. There is a steep change happening now in the pricing globally for insurers, which we believe that Beasley is going to take advantage of and be able to get some very good business on a go-forward basis. What we've done in the portfolio, we have bought a few names, we have sold a few names, and you can see Aon coming into the portfolio, the kind of capital light insurance broker business. They don't do any underwriting themselves. They just are a provider of linking up buyers and sellers. Equinor, the Norwegian oil company, is both a buy and a sell. You may ask, why is that? Well, as we have said in the past many times, that when there is a good opportunity to go into names that are very much out of favor and has a good risk reward, we're going to be there to take advantage of that. When oil was collapsing and nobody wanted to own oil companies, there was a really good chance to buy Equinor at some attractive levels. So we went against the flow, made a contrarian call, and bought Equinor, back during the sort of peak of the oil crisis. As oil has come back, it has been probably a little bit quicker than we anticipated, but then Equinor has re-rated, and at the current levels, the stock doesn't look materially undervalued anymore. So we have then been disciplined and exited that position. We've also exited Unilever, Hiscox, Schindler, Medtronic, for different reasons here, but basically you can say that the fundamentals look a little bit weaker for these companies currently, and we have found some better alternatives to pick up during the market environment, and that we think will give a better risk reward over time. And as of yesterday, we actually started buying a third new company, which will be disclosed when we present the Q2 report in early July. So the portfolio, if we break it down by sector, this is end of May, SKAGEN Global in blue, the index in green. You see we have no exposure to some sectors, energy, materials, real estate. We continue to have a fairly large exposure in the financial sector as defined by MSCI, but as we have pointed out in the past, actually around 2/3 of what is called financials in MSCI is, in our view, companies that should be classified in other sectors. We own the exchange operators. We think they are more like technology companies than financials. These companies down here, they are more professional services names, and they probably don't necessarily belong in the financial sector. So to be clear, we don't own a lot of banks. We only have one bank, and that's JP Morgan. And the majority of the financials exposure is sort of niche or specialized companies that, again, we think are misclassified in the index. Here's our top 10 list for April, and I'm just going to quickly point to the fact that we've said, no, we look for companies that have competitive advantages, that are profitable, that have good balance sheets. And when you compare what we have to the index, you see that our companies, they have better margins, better ROEs, lower debt levels compared to the index on the bottom line here, which is a different set of characteristics. Then I wanted to just spend a few minutes on an investment case, and that is Hannover Re, an insurance company, and reinsurance company to be precise. And a name that has actually been in SKAGEN Global for many, many years. This graph or table shows you the top 10 positions in SKAGEN Global for different years, going back to 2003, so 17 years ago. And we can see here, interestingly, that Hannover Re was in the SKAGEN Global portfolio already back in 2003, and it's been in the fund ever since, with the exception of about 4 years between 2014 and 2018 when it was not in the fund. But for most of the 17 years, it has been holding in SKAGEN Global. And I just wanted to kind of put this into perspective and give you some examples why we think that Hannover Re is a good example of a stock that fits the different criteria that we have put out on this slide as the investment framework. History goes back to 1966 for the company, so it has been sort of well established. It's been around for a long time. And as you can tell from the table, from the graph here, the stock has the company has a global presence, so able to take advantage of the insurance market, which is growing across the globe. It is one of the biggest in the world, actually number 3 based on premiums, and that is important because it helps you to get scale, and scale is something that is a clear advantage, competitive advantage in this type of business. The growth, kind of to demonstrate that the fundamentals are decent. This graph shows you that it has been almost a doubling in terms of the premium growth between 2010 and 2019, going from around 11 billion in 2010 to almost 23 billion in 2019. And we expect actually a very good growth over the next few years as well. And I'll come back to why that is. So why do we look at kind of think about the growth and why is that important? Well, if we look at the entire market, and I'll just maybe draw your attention to the yellow shaded area up here, kind of showing you that over this time period, the insurance market as a whole has grown by around 4.3%. Now, interestingly, Hannover Re, HR Hannover Re, has grown by 9.3%. Yeah, so a lot faster than the market, and basically the company has been taking market share. Hard to see from the graph, but it's basically gone from 6% in 2014 to 8% globally in 2018. And given that the company has upheld its profitability, it shows it must be doing something right. And how do we know that it has upheld profitability? Well, I mean, there are different ways of measuring that, but one way of looking at it is just to look at the ROE that the company has accomplished. And it has, as you can tell from this graph, ranked number one in almost every year between 15 and 19. So that's sort of a testament to that the company is a very good underwriter, good at pricing risk, and it also keeps a disciplined cost structure, which is sort of another attribute of Hannover Re. We talk a lot about the importance of having strong balance sheets. In the world of insurance, balance sheet strength is typically measured by the solvency measure. Here is a graph from May showing you the estimated solvency levels of companies, insurance companies in Europe. Hannover Re is the fourth sort of best capitalized companies in this graph. And again, just sort of another testament to how well sort of financially equipped the companies to deal with unexpected events and be able to pay claims and also grow when the market is changing. We've talked a lot about the importance of meeting with management, and SKAGEN Global think that governance is extremely important as we are long-term shareholders. We try to establish and think of our investments as a partnership mentality. Who would you like to partner with for the long term? And Hannover Re, we have met with their management team for many times over many years. And for example, last year we also went down to meet with the CFO, the former CEO, and the new CEO who has come in. He's not in the picture here, but we've met with all of them just to kind of be able to look them in the eyes, ask the difficult questions, but also hear, what their view of the world is and how the strategy is developing. Now, the final point I wanted to kind of point out here about the attractiveness is that after we've had a number of years with too much capacity in the whole insurance industry, high losses from typhoons, hurricanes, wildfires, and so forth, pricing has been going down since 2012. However, over the past year, we've been seeing an inflection point, and it looks like we are now actually going into a much steeper pricing environment, meaning that insurers can charge higher prices for insurance products. Yeah, especially after COVID, with all those business interruption losses, travel losses, and so forth. There is a strong momentum in the market, and we believe that Hannover Re is going to be extremely well positioned to capitalize on this business opportunity. On valuation, which is clearly something that is very important, we went back and we looked at what did people think about valuation in 2011 for Hannover Re. Yeah, because valuation often comes up as sort of something that people think that, well, Hannover Re, it looks a little bit more expensive compared to the other insurance names. And it's true that it trades a little bit more expensively, but that is because it offers much better return perspectives that you will see over the long term if you are patient. And going back to 2011 here, these are excerpts, so kind of short summaries from the reports from analysts at that point in time. And if you read them, you can see that back then, 2011, there was a fair amount of skepticism in the market. Yeah, so people saying that, okay, it's a good stock, but actually it looks expensive, or it looks fairly valued. There's no need to own this currently, and so forth. Yeah. It's worth pointing out that these price targets that the analysts who give recommendations, they are based on a 12-month view, so they're shorter term than our price horizon is. But that also gives you sort of an opportunity, because during this time period, from 2011 to today, the return has been pretty amazing. I mean, you can sort of guess quietly for yourself, what do you think the return has been in Norwegian krona between this time period? And the answer is over 800% total return. Okay. So when you take a long-term view, you see these kind of good growth prospects, then don't be scared away because someone with a shorter time horizon may try to recommend that you buy something else instead. And actually, if you take the really long view, if you go back to 2003, where we started to kind of talk about Hanover Re, and you look until today, in Norwegian krona, the total return is actually a staggering 1,700% almost during this time period, with more than 1,200% outperformance compared to the index. So it shows you kind of the immense benefit from compounding, and we believe that if you hold this stock for another 5 or 10 years, there continues to be a tremendous upside in the case as we see it today. So with that, just a few final slides on the outlook for the economy. And obviously things change pretty quickly from one month to another these days. But it's interesting that the Bank of America Global Fund Manager Survey is something that comes out every month. And Bank of America essentially surveys, I think it's around 300 or so fund managers, what they think about the world and different investment aspects. And in April, when they were asking what they think the recovery was going to look like, there were only 15% who believed in a V-shaped recovery. And I believe the figure for May was even lower, I think around 10% or so. So obviously the fund managers, they were not very optimistic about a quick recovery for the economy. The biggest tail risk that the fund managers have pointed to has been sort of a second wave from the corona. Again, maybe not overly surprising. Other things that kind of stand out would be, kind of the high unemployment, breakup of the European Union. So these are sort of tail risks, that are featuring in investors' minds. And clearly the cash levels have been high. Again, a graph from Bank of America showing you the average cash balances going back all the way till 1999, and currently we are at levels that are basically on par with where they were at the time of the September 11 attacks. And you can look at this as a negative sign in the sense that people are understanding or predicting that it's going to be a bad time to be in the market and they choose to be in cash. Or you can look at it more from an optimistic point of view and believe that, okay, there's a lot of cash on the sidelines now, they can come in, they can push the market higher from here. The different views, this slide that we've talked about for a little bit in the past few weeks, if you kind of think back to May, then the negative view was very much kind of the consensus view, and at that time we thought that you should also think about the positive view, at least consider what that could mean. Now, with the big rally that's been going on for the past few weeks, the market has essentially been embracing the positive view here, and today it's the positive view almost seems to be more consensual than the negative view. So we can see where things stand, but clearly there's a much more balanced picture now compared to just a few weeks ago. And that, of course, brings us to the key question. I mean, what do we see when we look in the crystal ball to try to predict the future, what's gonna happen next? And what we see is essentially this. I mean, that we again, we are not believers in predicting the market or predicting macro events. We are not epidemiologists, so we can't make those predictions better than anybody else. So it means that basically in the shorter term, it's kind of blurry to us. You know, things can go up, things can go down, and that may not be what people are kind of looking for when they ask someone for a forecast, but we think that's actually the reality. That's where we are, and that's why SKAGEN Global today and in the past has been focused on companies. Yeah, companies that can ride out different type of scenarios and still create shareholder value. If you take the longer term, we do agree that we think that it looks brighter, and there are many factors that would support actually a quite good stock market environment if you take a multi-year view, which is what we do, and we think that investors should do the same and stay away from the noise and really kind of look out into the future from that perspective. To summarize, I mean, we talk about tuning out the noise, really kind of focusing on your process, not getting drawn into trying to be controlled by fear or emotional feelings, innuendos and so forth. Stay disciplined, follow your process. Number two here, don't try to time the market. You know, there's been numerous market calls up or down here over the past few months, but we think that that's a futile exercise, and we recommend to keep cash levels low. SKAGEN Global, we have kept cash levels low or very low during this year. We've been below 2%, and actually for most of the time we have been below 1%. Yeah, and that helped us when the market kind of came roaring back in March, and that we didn't sit with a lot of cash, and we don't intend to have a lot of cash going forward. Either we want to give everybody who is in the fund maximum equity exposure. Because if you invest for the long term, as you can kind of tell from this graph, if you want to benefit from the huge compounding attribute of stock markets, then you have to be invested. You cannot have cash on the sidelines, but be in the market and just use any sort of dips to either reposition or maybe even better yet, just kind of sit through them, or if you have additional capital coming in, add at as much as you can at those times. But that's kind of how we think about the world, and now we open up for some questions.